Treasury would have a windfall free and clear of about $1.2 trillion deposited into their checking account with which they can do whatever he wants within reason. Now, the problem is we have $27 trillion, the Treasury market's $25 trillion in debt, $37 trillion overall. I think the Treasury market is $27 trillion in size. So that's a whole 4% of the Treasury market. It's not big enough. Now, if gold was $20,000 an ounce, that would be about $5 trillion. Gold was $40,000 an ounce. That gets you about $10 trillion. He could literally wade into the Treasury market with that $10 trillion windfall, which is essentially just straight money printing using the gold. We would not have to sell a single ounce of gold to do that. It's just an accounting creation gimmick.
Luke Gromen explained a striking scenario where the U.S. Treasury could unlock trillions of dollars in liquidity without selling a single ounce of gold, simply through revaluation. If gold were marked up to $10,000 an ounce, the Treasury would instantly gain about $1.2 trillion in value deposited into its account. But, as Gromen notes, that's still small compared to America's $27 trillion Treasury market. At $20,000 gold, the windfall jumps to $5 trillion, and at $40,000, roughly $10 trillion, enough to wade into the bond market with massive buying power. He emphasizes that this isn't about gold sales or new debt, but rather about accounting-based liquidity creation, a financial maneuver that could reshape global confidence in U.S. fiscal management. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Treasury would have a windfall free and clear of about $1.2 trillion deposited into their checking account with which they can do whatever he wants within reason. Now, the problem is we have $27 trillion, the Treasury market's $25 trillion in debt, $37 trillion overall. I think the Treasury market is $27 trillion in size. So that's a whole 4% of the Treasury market. It's not big enough. Now, if gold was $20,000 an ounce, that would be about $5 trillion. Gold was $40,000 an ounce. That gets you about $10 trillion. He could literally wade into the Treasury market with that $10 trillion windfall, which is essentially just straight money printing using the gold. We would not have to sell a single ounce of gold to do that. It's just an accounting creation gimmick. And he could buy back, $10 trillion on $27 trillion Treasury market, $25 trillion Treasury market. That's 40% of the market. Now our debt to GDP is not 120%, it's 80%. And oh, by the way, the monetary multiplier of printing that much money and injecting it essentially into the economy, right? Because if you own treasuries, now you got cash. You're going to spend it. GDP would probably grow 20, 30% for 2 or 3 years. Fed would have to cap rates, but the net of it would be after 2-3 years, we would have debt to GDP of probably 25%, 20%. And now the Fed can act independently, manage the monetary system, etc. Now, I think it's really important. Those numbers sound preposterous, but if you look at the market value of U.S. official gold, just the market price times our 8,100 tons, as a percentage of the foreign held portion of U.S. treasuries outstanding, today, with the massive run we've had in gold, that is at 11%. Now, by way of comparison, in 1989, when the Berlin Wall came down, it was 20%. So gold would have to almost double just to get back to 1989 levels on that metric. The long-term average is around 40%. So gold would have to quadruple from 4,200 an ounce just to get back to the long-term average. And in 1980, when we had an honest-to-goodness dollar crisis, that percentage was 135%. So in 1980, foreigners could have brought all of their foreign debt to the U.S., demanded gold, taken gold, and we still would have had a third of our 35% of our gold left over. That is a gold bubble. Our foreign debt was 135% gold back. Today, it's 11.
Luke Gromen outlined a powerful yet largely overlooked mechanism, a simple revaluation of gold that could dramatically reshape U.S. debt dynamics. If gold were lifted to $40,000 per ounce, the Treasury would instantly generate a $10 trillion windfall, enabling the government to buy back 40% of its Treasury market without issuing new debt or selling an ounce of gold. This would slash America's debt-to-GDP ratio from 120% to near 80%, potentially sparking 20 to 30% GDP growth over several years. Gromen notes that even today, U.S. gold holdings equal just 11% of foreign-held treasuries, far below the 40% long-term average and the 135% level reached during the 1980 dollar crisis. By those historical measures, gold remains drastically undervalued. Let's get into the interview.
I think the reason gold's going up the way it is we have reached a critical tipping point of oil in particular, but commodities more broadly, being priced outside the US dollar. So most of your audience will be very familiar with the petrodollar system, where oil only priced in dollars post 1971, and commodities more broadly around the world only priced in dollars. Beginning around 10, 12 years ago, China began advocating for shifting some of their commodity import bill into Chinese yuan. They did this not because they hate the dollar, or they want to tip over the dollar, or they necessarily hate the US. They did this for a very practical reason, which is they were certain to have a commodity crisis like we saw in Southeast Asia in the late 1990s if they did not start to buy more of their oil and other commodities in Chinese yuan. Why? Because China is growing. China has a finite stockpile of dollars, right? They have a certain amount of dollar reserves. Their economy is growing. Their oil usage is growing. The price of oil was going up over time. And so you could just do the math and say, okay, well, if we have a fixed number of dollars, economy grows, population grows, oil use grows, oil price grows, we're going to run out of dollars to buy oil sometime in the next X years. And when we run out of dollars to buy oil, we are going to have to do one of two things. We're either going to have to significantly shrink our economy, political no-no, collapse our economy, use less oil, or we're going to have to devalue our currency, which will then send our price of oil and overall inflation up. And that is also a no-no. That'll be, a currency crisis, a political crisis. And so what the Chinese decided on was we need to be able to buy oil in our own currency, in the Chinese yuan. The problem with that is twofold. Number one, we need to find someone willing to sell it. And number two, how do we get people to trust the Chinese yuan? How do we get oil producers to trust taking the Chinese yuan? Because nobody trusts the Chinese yuan. And what they arrived at was setting up a system where you can settle on a net basis any yuan surpluses you end up with as an oil exporter in gold. Nobody trusts the yuan more than the dollar, but everybody trusts gold more than the dollar. Witness farmers holding gold. And so what they have done is essentially, now who did they find to sell? Well, it started with Russia. And Russia has been doing this for 10, 12 years. I think it has factored very heavily into U.S. foreign policy decisions relative to Russia. But we haven't been able to do anything about it for a number of reasons. And so I think what we're starting to see in gold markets is a tipping point where you're seeing other oil exporters doing this. Iran, for example, Venezuela, also coincidentally enough, added to the top 5 list of regimes we would like to regime change. Last week we saw BHP Billiton, the gigantic Australian iron ore miner, say that they had agreed to price 30% of their iron ore in the spot market in Chinese yuan. And so as this system gains traction, this makes great sense if you're an oil exporter, right? It's literally what we're advising farmers to do, right? If you own gold or Bitcoin and you're a farmer and you're taking some of your farming surplus, the dollars you earn every year, and you roll it into gold, guess what happens? The world keeps getting cheaper to you. Well, that's literally what China and Russia have been doing for the last 10 to 15 years, which is, all right, if there's net surpluses left over from us selling you oil, Russia's going to end up with yuan. They can change some of the yuan into gold. Russian gold reserves go up. As Russian gold reserves go up and the price of gold goes up, Russia is effectively using their commodity production to bid up the price of gold and recapitalize their FX reserves. It's not the issue, but the reason I think why gold has begun going up on every day that ends in Y, it seems, is that we've reached a tipping point on this. It accelerated after we seized Russian FX reserves in 2022, right? I mean, if you're a farmer, imagine if the U.S. government came to you and said, you know what? We don't like your political views. We're going to take, all the money you have in the bank in dollars, we're taking. That's what we did to Russia in 2022. I'm not saying I'm not making a political statement here. I'm just telling you the facts of the case. And if you're China, if you're Saudi Arabia, you go, wait a second, that could be me. And so what did the Russians do? They bought gold. What did central banks do? They bought gold. And so this trade is getting momentum. The point here is that as we sit today, if we took the total, 105 million barrels of oil per day produced times where are we at, $62 a barrel, times 365 days a year, and then we compare that to global gold mining production every year of call it 3,000 metric tons, $4,200 an ounce today. The oil market alone is still probably 6 to 8 times the size of the global gold market. So you're basically trying to fit the oil market, which is 6 to 8 times bigger than the gold market, into the gold market. What's going to happen to the price of gold as that happens? It's going to go up. Now factor in iron ore, copper, gas, all these other commodities. Global commodity markets, as they begin being priced also in Chinese yuan and in other BRICS currencies, but I think it's made primarily the yuan. Even the Indians last week were reportedly buying oil in Chinese yuan from Russia. You're going to be trying to fit 10 to 15 pounds of commodities into a 1 pound bag of gold.
Luke Gromen explains that gold's relentless rise is being driven by a structural shift: the global repricing of commodities outside the US dollar. Nations like China and Russia have quietly built a parallel system, one that allows trade in yuan convertible to gold, effectively bypassing the dollar-based order. When Russia began selling oil to China in yuan and settling balances in gold, it created a model for others: Iran, Venezuela, and now even large producers like BHP Billiton, which recently began pricing part of its iron ore exports in yuan. The 2022 seizure of Russia's reserves only accelerated this movement, signaling to every major commodity exporter that their savings aren't safe in dollars. As oil, gas, and metals move toward this new settlement structure, gold becomes the bridge and the ultimate collateral of trust. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. Thanks for watching.